these extraordinary times. And the stimulus checks and the Paycheck Protection Program have been tremendously successful in bringing much-needed relief to hard-hit American families. It's been huge. Nothing anything like it before. It's great. It's the very best there is.
Thank you.
I want to commend Chairman Powell for his leadership to keep the financial markets stable and liquid in the face of the downturn in the general economic conditions. We await the full implementation of the Main Street Lending Program, and I'm looking forward to hearing more about that. First question is, our nation's hoteliers have been facing one of the most severe downturns in demand of any sector of our economy. The revenues have plummeted as much as 80% during the shutdown, and extreme curtailment of travel, as you know. I'm wondering, and I'd like a response from both of you, if you have the authority you need under Section 13.3, Sub 3 of the Federal Reserve Act, and more broadly the CARES Act, to address the liquidity and cash flow crisis that the hotel sector will be going through. So, either one first.
I'll go ahead. We are not looking for additional authority under 13.3. Our authority is, of course, to lend to solvent institutions and in programs of broad applicability, and any company in any sector that meets those tests can borrow at one of our facilities.
Yeah, the only thing I would just add to that is that we do appreciate, and certain comments have been made by this committee already and others, as it relates to loans that are in securitizations, and particularly hotels and other real estate that was properly levered beforehand. It does not lend itself as well to the 13.3 facilities, and we continue to look at that.
Okay. Mr. Chairman, some of our businesses, including, again, the hoteliers, are warning that their inability to make payments is threatening the servicing of commercial backed securities. And I just wonder if you can bring us up to date on the status of the CMBS market.
Well, as I just mentioned, one of the problems of the CMBS market is there are very strict contractual obligations. And that's why one of the things I do think we need to look at in the next CARES Act is additional funding for these industries that are the hardest hit, so they can continue to rehire people, so that as occupancy increases, that they have employees that they can maintain.
Great, thank you. I recently wrote to both of you expressing my concern for businesses that are asset-based, and I believe they'll face hurdles to assessing Main Street lending facilities because of the nature of their business challenges, their ability to meet lending criteria based on the earnings before interest, tax, depreciation, amortization, so-called EBITDA. For example, an aircraft developer in my district, especially an R&D organization, falls into this category. And I wonder if you could tell me what the possibilities are of providing access to Main Street lending facilities for businesses like that. And you go first, Mr. Secretary.
We've discussed about looking at asset-based financing, and that's something we continue to discuss with the Federal Reserve.
Okay. Mr. Powell?
Yes, that's where we are.
All right. Thank you, Madam Chair. I'll yield back.
Thank you. Mr. Clay, you're now recognized for 5 minutes.
Thank you so much, Madam Chair, and thank both witnesses for your participation today. Mr. Secretary, I'm somewhat troubled by recent reports that some banks have taken stimulus payments from individuals and families with garnishment orders or negative account balances to offset unrelated debts owed to them. I find it troubling that banks would serve as debt collectors at a time like this when families need the resources most. When will Treasury issue guidelines articulating your expectation that financial institutions refrain from taking stimulus funds away from their customers during a time like this?
Well, let me first say I agree with you, and that I think it would be awfully unfortunate if banks are doing that. We have had inquiries about the issue of garnishment, and we agree from a policy standpoint that there should have been no garnishment. Unfortunately, that's something we need to address in the next CARES Act if we do additional direct payments, because there are certain state laws that were not overridden in the existing CARES Act. But my understanding, that's a state issue and not a federal issue. We agree from a policy.
But think about the cruelty of the policy. Wouldn't you want to?
As I said, I agree with you on the policy.
Couldn't you all issue a blanket guidance?
We've asked our legal department, and unfortunately we can't, and that's one of the things we would want to fix in the next CARES Act. So we agree with you from the policy standpoint.
Thank you. Chairman Powell, for many nonprofits and small businesses, earnings before interest, taxes, depreciation, and amortization is not a widely used metric. Have you considered applying other metrics of debt, future growth, or financial health to the Main Street lending program so that nonprofits and small businesses are fully able to participate?
Yes, as a matter of fact, we have, particularly for nonprofits, of course, earnings before interest taxes doesn't make any sense. So you don't need to take taxes out. They're nonprofits. They don't pay tax. So we're looking at a range of, and we actually put this out for comment. We got a lot of very thoughtful comments from the nonprofit community of looking at cash flow and also financial resources more broadly. In terms of companies, EBITDA is just basically pre-tax cash flow. It's a very widely used metric, but there are other metrics. And as the Secretary mentioned, one of them, probably the next one in line, is something along the lines of asset-based, and that's something that we're looking at with the Treasury.
Now, under the Main Street lending program, you reduced the minimum loan threshold from $1 million to $250,000, and then by expanding the program to nonprofits with more than 50 employees. However, many small businesses may not need $250,000. Mr. Chairman, has the Fed considered eliminating the minimum loan threshold altogether?
We have not considered eliminating it yet. Of course, and we're just now getting rolling with loans, as you know. So we can, once we get up and running, look at lowering it again. But you get into a very different kind of lending when you're down lower. These are really personal loans rather than business loans. They're generally guaranteed by the business operator. And we could look at that, but that would be something we'd look at once we get up and running.
Yeah, but I mean, it's kind of concerning that you have that threshold at $250,000 when, say, a small business in St. Louis needs $100,000 to survive through this pandemic until they get back on their feet. Any consideration given to accommodate?
Yes, no, we can see ourselves possibly lowering the threshold again, but just logistically, for us to be making very, very small loans would be difficult, and those people may be better dealt with through fiscal policy. But I can see us down the road looking at a lower threshold.
I see. And thank you both for your responses. And Madam Chair, I yield back.
Thank you. Mr. Scott, you're recognized for 5 minutes.
Thank you, Chairman.
Yeah,
I'm on.
yeah.
I think I need. Chairman Powell. Now we all know that job losses have disproportionately impacted women, African Americans, and other minorities, but at the same time, our capital markets have improved significantly since the epidemic. Why is this? Is there something you're doing more so to help the capital markets than helping job losses corrected?
No, not. In fact, the objective of everything we're doing, every single thing we're doing, is to take the 25 million people whose working lives have been disrupted and create a situation in which they have the best chance to go back to their old job or to get a new job. And that includes all the facilities that we're doing. That's the overriding goal of what we're doing, and every one of them helps in that direction.
Yeah, I know that's your goal, but something. What I'm trying to get at is it correctable? are there some things you can do to fix this imbalance between staggering, lowering unemployment and soaring rise in our financial capital markets?
So we're trying to, what we've been trying to do is create accommodative financial conditions and supportive financial conditions so that when the economy reopens, remember we sort of deliberately closed down, so that when the economy reopens, that expansion can be vigorous and strong, and it's just beginning now. So our support for that is part of what's driving the job growth that you saw in May, which was surprising to the upside.
Yeah, I also, while we got both of you all here, I want to pick up on what Chair Lady Waters was saying. We got a great opportunity here to do both of these things with our housing and homeowner tranche that we're putting forward. This goes right into the belly of our economic wheelhouse, jobs, keeping people secure, because it's coming, man. When you lose 25, 30 million people lose their jobs, how they gonna pay their house note? How they gonna pay the rent? How they gonna pay utilities? And more than that, how the banks and the financial institutions going to get their mortgage payments in so that they can make payments for the securitization of those mortgages that keeps our financial system healthy. So I want to ask you to make sure that you all start talking about these things that we are putting forward. May not be everything you agree with us on, but this is one that is very important. Now let me go to one other area, to you, Secretary Mnuchin. None of the lending facilities established have targeted the needs of our agriculture industry. Now, why do I mention that? Food. It's coming. I mean, I can't see why people can't see this crisis. Food shortages are coming. It's almost like the farmers have been the forgotten ones. Are they qualifiable as small businesses? Many of them don't know. They're sort of out there, just drifting along the misty flats. What are you all doing to help lift up and make sure that we give our farmers, our rural communities, the kind of help that they need? Because all the food chain is going down. You hear about the closures. The food processors are going out. Farmers are coming. These are small, most of them, but they're very important. Why can't they be qualified as small businesses? Where are they? They're getting lost in the shuffle. And if we get a food shortage, we're in, well.
Thank you, Mr. Lukemeyer. You're recognized for 5 minutes. I would encourage all of the members to keep their mask on, please.
Thank you, Madam Chair. And thank you, Secretary Mnuchin and Chairman Powell, for being here today and for your great leadership during this time. You know, as we've gone through this, you guys have been very responsive. You've been very cooperative. I can tell you from discussions that we've had in different settings, you've implemented lots of suggestions that we've come up with as a group, as Congress, and for that we're grateful. You know, leaders make tough decisions in tough times, and you both exhibited the ability to make those tough decisions, so thank you very much. Both of you in the past have expressed your support for housing finance reform and GSE credit risk transfer, CRT. And in prior testimony, you've committed to reviewing your prospective policies to determine whether capital relief is appropriate for U.S. banking organizations that engage in CRT with sound counterparties. FHFA recently reproposed a capital framework for Fannie and Freddie. which adopts much of the U.S. banking framework, but in doing so, seems to have taken a confused and more punitive approach to certain types of CRT. I'm encouraged by the questions posed in the proposal that would seem to indicate there remains room for a revision before the rule is final. I ask each of you gentlemen whether you still agree that it is appropriate that the enterprises should receive meaningful capital credit for sound CRT transactions they conduct with sound counterparties and avoid the accumulation of credit risks on the balance sheets of two institutions that remain taxpayer-backed. One of you?
Yes, I agree that they should receive relief, that we should encourage them to do credit risk transfers with credit-worthy counterparties, and I can also tell you FSOC is beginning to review these issues as well.
Chairman Powell, you want to comment on that as well?
Yeah, no, I do agree, and we're actually in the middle of doing a careful review of the whole capital proposal as well.
Okay, thank you. As you know, it's hard for me to let a hearing go without talking about CECL, so we're going to try one more time. In March of this year, the Federal Reserve and the FDIC and the OCC issued an interim rule to delay for 2 years the estimated impact on regulatory capital of CECL, followed by a 3-year phase-in. In addition, the CARES Act included an optional delay in CECL implementation until the end of 2020 or the end of the pandemic, which 25% of applicable entities actually opted for. The Department of Treasury is also conducting a study with the impact of CECL, I hope. We were directed to do that. And most recently, my colleagues and I sent a bipartisan letter to FSOC urging for delay in CECL implementation for all entities until 2022, so that every entity, both banks and non-banks, which were not included in the CARES Act, are on the same footing, and Treasury can conduct this study with the input of a real-life scenario that we have ongoing today. Given the actions by Congress and the prudential regulators, should we delay CECL as I and my colleagues have called for? And should the Treasury examine the real-life scenario we've gone through when conducting their study? Mr. Mnuchin?
I think that should be seriously considered, and yes, we are working on the study.
You know, the President issued an executive order with regards to each agency going through and looking at all the rules, regulations that were either waived, declined, changed, whatever. But if they don't work now, why should we continue them down the road when we get out of this mess? And so I assume everybody is doing that. And this particular accounting principle would seem to fall in that area of we need to be looking at this as something down the road we need to get rid of in its entirety. Mr. Powell, Chairman Powell, would you like to comment on this as well?
No, I would agree.
Okay. Thank you. Appreciate that, because I think there's a time and place for rules and regulations. There's a time and place that if they're not functioning, we need to get rid of them and start over. With the nationally recognized statistical rating organizations and the Federal Reserve emergency facilities, I know you've heard a lot about this issue from members on both sides of the aisle. Chairman Powell, especially, the Fed took modest steps to include smaller NRSROs in the most recent FAQs, but only if those ratings are accompanied by one of the 3 incumbent NRSROs. I remain concerned that Fed's unilateral and haphazard tiering of these NRSROs is going to have serious implications for small and mid-sized businesses. Have you examined the impact the delineating between the large and smalls is having in the marketplace?
Well, as you mentioned, you know, we started out getting these facilities set up very quickly, and we just went with the big 3. After that, I think more than a month ago, we broadened it out to another group after taking a look. And, you know, we're balancing the need to move quickly and to move with institutions that we know well or that are well known, and then we've included more and more, and that's a process that we're still looking at.
Okay. All right. Thank you very much. I yield back, Madam Chair.
Thank you. Mr. Huizinga, you are now recognized for 5 minutes.
Point of inquiry, Madam Chair, should it not be on the other side of the aisle? Oh, I'm sorry. Okay. All right. So, well, thank you. I appreciate that. Chairman and Mr. Secretary, you know, the word unprecedented has been banned in my house by my college, well, graduate. He graduated remotely because he was looking around and was a little tired of that word maybe being used. So he has a history. His grandfather, my dad, was born in 1921 on a kitchen table in the hired man's home. My mother was born in 1931 in Flint, Michigan. Yes, that Flint, Michigan, and had to move to Oklahoma into the Dust Bowl in the middle of the Depression. to try to survive when they lost their house and my grandfather lost his job. We know that there's history behind this. So I'm not sure if this is unprecedented. It certainly may be unprecedented in a way in the modern era where we've seen the government come in and sort of shut this down. But what we do know is from looking at history is we need to get the economy moving again. Now the question is how? Whether it's getting kids back to school, as some have suggested, because if you can't get kids into school, that's not going to then free up those parents to be available to work. Anecdotally, in my area, I know that manufacturers and service companies are having a very difficult time getting enough workers to come in to complete a full contingent of line workers, for example, or to get a full shift filled. And there's various reasons. Some have debated about the $600 additional per week kicker as being a bit of a disincentive. But nonetheless, we know that we have to address those folks who really, truly are not able to get a job, and how do we distinguish from those that are just deciding not to take that job. One of the things that I have proposed is something called the Patriot Bonus. Patriot Bonus would be a 50% tax credit to any company that would give a per-hour bump to their employees, or a weekly bonus to their employees, or even a one-time bonus to their employees, to incentivize them to come off of that unemployment insurance system and get back engaged in the workforce. And I think it's critical that we do that. I do want to say also thank you for your work on the Paycheck Protection Program. I've talked to Cheryl, who owns a very popular bagel and coffee shop in my hometown, who knows that she survived because of it. Don, who owns a bowling alley in my district, who was able to keep his folks on the payroll. Those types of things are critical and were very, very important. As we're shifting to the Main Street program, I do want to draw attention, and Chairman Powell and I had this conversation a couple of weeks ago. I brought up Lacombe. Lacombe is a Philadelphia-based company that has a manufacturing production facility in my district. It's a 26-year-old fast-growing company. You may have gotten their coffee in the can, and they produce a number of great products. But for the last 6 years, they've been really focused on their growth. And that also means they've had to borrow a tremendous amount of money, and that led to an accumulation of debt. Under some of the rules as they're currently written, Lacombe would not qualify to participate in the Main Street lending program. And I believe that the way that the leverage ratio requirements in the program are currently drafted really sort of frankly punishes companies like Lacombe and others who would otherwise be viewed as really, frankly, success stories. So if it is the way the rules are currently written, it's designed to prevent funds from going to companies that have this debt, but sometimes those companies might be some of those that need it the most. I'm hoping that you'll commit, Mr. Secretary, to working with me on that to address that issue.
Yes, I'm not familiar with the company, but we're happy to follow up with you and see if it can work.
Great. And then in the remaining time, I talked to Jeff this morning. Jeff is 52. Talked to Jim and Liza. He's 64. She's slightly younger. She won't tell me exactly how old. But what I do want them to know is I want them to hear from you. What do you want to tell them and the rest of Joe and Jane 401k that have their small investments in the markets that are there, frankly, to help them as they approach retirement? What assurances can we give them about the economy?
Well, I want to tell them and all the other people that we are going to work with Congress to make sure we can do whatever we can do to get everybody back to work who lost their job because of COVID. And I'm also extremely optimistic about the research that is being done on vaccines and virals and us combating this terrible disease.
Thank you.
Yeah, I would just say
Mr.
that,
Meeks, you're recognized for 5 minutes.
Thank you, Madam Chair. Mr. Powell, you and others at the Fed have written and spoken about the importance of maintaining the economy at full employment as a way to pull a greater share of the minority workforce upwards, which is often the first to be laid off and the last to be hired. And while this is helpful, this is incredibly frustrating as it is an admission that everyone else gets a head start in the economy, and communities of color only get out of the starting blocks after everyone else has been running the race for months, years, or decades. So let me ask you first, Mr. Powell, do you agree that structural discrimination exists in the United States economy today and impedes the economic success of communities of color and is a key to understanding why black wealth is just 10% that of white communities?
Yes, I do agree.
Mr. Mnuchin, would you agree also?
I agree we need to do everything to create a level playing field, yes.
So I also believe that our approach to redressing the legacy of economic racism and discrimination must include equity investments. Communities that have been financially excluded for decades or hundreds of years that were disproportionately impacted by the financial crisis and now by the COVID pandemic cannot borrow their way out of poverty and economic exclusion. I believe that sizable equity investments over the coming decade or more into communities of color will be essential to substantially lift them out of poverty and build resilience. And I'm working on a proposal for creating a national investment fund, pulling together capital from both the private sector and government to invest in these communities over the next decade or more. So, Secretary Mnuchin, do you agree that massive amounts of equity investments will be required to lift these communities and that debt alone cannot solve the problem?
I definitely think investments in these communities is important, and we look forward to working with you on your specific ideas.
So, great. And the same with you, I guess, Mr. Powell. Can we count on the fund and you working with us?
We'd be delighted to.
So back to you. Given that, Secretary Mnuchin, the Treasury Department has the capacity and the authority to invest Tier 1 capital into minority depository institutions, MDIs, but has never done so. Similarly, the Treasury Department could use existing authority to mobilize deposits from trust funds into MDIs, either directly or through custodial accounts, but it does not do so. And since we agree that we need to have investments, would you agree that MDIs play a critical role, as we found during PPP, in providing minority communities access to capital? And ask you then, will the Treasury use its existing authority and capital to provide direct support to MDIs?
I'll have to review those authorities and get back to you. So if that's something we have, it sounds very interesting. I'm not familiar with those specific authorities, so let me look into it. And let me just say also the CDFIs did a terrific job as well.
I agree. I should have added the CDFIs. We concur on that. So, but I look forward to working with you to make sure that we're investing. I mean, we have, public money as well as private money to invest in those MDIs so that they have the capital and the wherewithal to move forward. That is the way to go. Now, have the Fed and or the Treasury Department made on another issue, I'll ask Mr. Powell this, has the Fed made a requirement of all asset managers and broker-dealers with which they contract to partner with minority firms in fulfilling contracts and transactions?
Yes, we do have obligations, for example, with the companies we've contracted with during the pandemic. They have to address diversity and inclusion issues at their company, and they have to also reach out to minority suppliers as well.
And the Treasury, Secretary Mnuchin?
Yes.
Okay. So then I'm hearing from both of you that you'll commit to incorporating this and making it a standard for the Fed and the Treasury policies across all capital market programs that involve partnerships with private sector asset managers or broker-dealers going forward with minority broker-dealers and asset managers. Is that correct?
That's really part of our rule book now, actually.
Mr. Mnuchin?
Yes, that's something we work on as well.
Thank you. Out of time, I yield back.
Mr. Stivers, you're recognized for 5 minutes.
Thank you, Madam Chair. Thanks for being here, Mr. Secretary, Mr. Chairman. I really appreciate it. Secretary Mnuchin, I'm hearing from some lenders that are being accused of failing to pay agents who assisted businesses in preparation of their Paycheck Protection Program loan submissions. And before participating in PPP, I heard comments from banks that they were worried they might be exposed to legal liability without sufficient safeguards in what's essentially a government grant program. But they largely participated anyway because obviously they felt like they had a duty to their customers and the country during a time of need. Now I'm told that many banks are being targeted by litigation that takes advantage of the lack of clarity about how agent fees are supposed to be processed and how they work. For example, banks don't have precise answers on where the fees were supposed to come from. Is an agreement between a bank and an agent required before any work on the application is completed or processed? Is this an issue you're aware of, and does Treasury have a plan to offer any additional FAQs to clarify the issue of agent fees and when they're due and how that works?
So I have recently become aware of this issue as well. What our guidance did say is that banks could pay agent fees out of the fees that they received. That was intended to be based upon a contractual relationship between the agent and the bank. And to the extent there's any confusion on that, we'll look at clarifying that.
It'd be great if you could do a clarifying FAQ, because I think it'll prevent some litigation, or at least allow for that litigation to move expeditiously and less costly through the process. So
we'll review that. Thank you.
Thank you, Mr. Secretary. Chairman Powell, Treasury and the International Association of Insurance Supervisors have stated publicly that proposals to retroactively amend business interruption insurance policies to cover COVID-19 claims would endanger financial stability. Specifically, AIIS stated that they caution against initiatives seeking to require insurers to retroactively cover COVID-19 related losses, such as business insurance, and that those things were excluded in the insurance contracts. Such initiatives could ultimately threaten policyholder protection and financial stability. Do you share the concern requiring payouts of uncovered policies, and that they could result in insurer insolvencies and destabilize our financial system?
So that's an issue that's really kind of outside the periphery of our authority, except as you point out, to the extent to which it relates to financial stability. So we're monitoring it. So far, we haven't taken a position on that, but we're aware of it.
Please continue to monitor it. If it results in any kind of destabilization of the financial system, that's your role. I get it, and I'm not asking you to exceed your role, but please pay attention to it. Chairman Powell, could you kind of give us an overview of the current state of municipal finance markets and the effectiveness of the Fed's efforts to stabilize those markets?
I'd be glad to. So the municipal markets, like so many other markets, really just about shut down in the middle of March, and we announced the municipal liquidity facility, and really that announcement has had an enormous effect on the functioning of that market. So you see a lot of healing in that market. You see plenty of issuance of issuers of different credit ratings and also different kinds of issuers, revenue issuers. So it hasn't returned to where it was in February of 2020, but there's been a lot of progress. So as an example, the state of Illinois did most of its financing in the private markets without our support, and then came to our facility for its last piece of financing. So I'm very pleased that the announcement effect was very strong and effective, and is helping a lot of borrowers now.
Finally, I just want to say thank you, Secretary Mnuchin. Thank you, Chairman Powell, for your incredible leadership and availability through this crisis. This hasn't been easy. Clearly mistakes will happen when we're in uncharted waters, but you both have been bold in your leadership. You've made a difference. You've helped businesses survive. You've helped the economy survive. Thank you for your incredible leadership. And we wouldn't be doing as well without it. There's more work to be done. I appreciate everything you have done, and hope you'll continue to focus on small businesses and medium businesses around Main Street, because they're still struggling. Thank you so much.
Thank you. Mr. Green, you're recognized for 5 minutes.
Thank you, Madam Chair. I thank the witnesses for appearing as well, and I'd like to lay a proper predicate for my questions. According to the latest HMDA data, in 2019, the vast majority of home purchase loans went to white borrowers at approximately 10 times that of loans that went to black and AAPI borrowers. Here are the numbers. The share that went to white borrowers, 60.3%. To Hispanic borrowers, 9.2%. To AAPI borrowers, 5.7%. And to black borrowers, 7%. 60.3% to white borrowers, 7% to black borrowers. Even when lending discrimination does not result in outright denials of credit, it drives up borrowing costs for minority home buyers. Loans to black and Hispanic borrowers continue to be higher priced for both conventional and non-conventional loans in 2019. Home purchase loans were higher priced for the following share of borrowers. To black borrowers, 20.3%. Hispanic borrowers, 23%. White borrowers, 8.3%. Consistently, we see empirical evidence indicating that there is invidious discrimination in lending, especially as it relates to people of color. So here are my questions, dear friends. Adjusting for education, credit score, assets, and other relevant factors, do you believe that invidious discrimination in lending exists against borrowers of color? I have been collecting these pictures. I keep them in my office. These are pictures of people who deny the existence of invidious discrimination as it relates to people of color. So my question to you is, do you believe that this invidious discrimination exists in lending as it relates to people of color? If you do believe so, would you kindly extend a hand into the air? All right. Would you kind of hold it up just like to get a good picture of you, Mr. Secretary? All right. Thank you very much. Now, next question. Do you believe that this invidious discrimination against borrowers of color can be addressed with legislation? Can we craft legislation to help end this invidious discrimination? If you think so, would you kindly raise a hand? Legislation. Can we craft legislation? Chair Powell seems to think so. Mr. Mnuchin?
Can I respond to the answer?
Well, you can respond, but if you would be so kind as to let me know where you're going first. Sometimes when people finish, I don't know what they've said.
I think
this wouldn't apply to you, of course. So
I think we have legislation, so I think we need to do a better job. So I'll say we can look at legislation, but I think it's more than just legislation.
okay, I agree with you that it's more than legislation, but would you agree that legislation can be a part of the remedy? If you'll kindly extend a hand. Thank you. Now, I'm in agreement with you. We have a couple of pieces of legislation. H.R. 149, the Housing Fairness Act, helps to deal with discrimination in housing as it relates to people of color and others as well. And then H.R. 166, the Fair Lending for All Act, that would put an end to this race-based lending and discrimination. Two pieces of legislation, hopefully they'll move in Congress. But here's my final question. I believe that it's time for us to reconcile in this country. We've survived slavery, but we didn't reconcile. We survived the invidious discrimination that exists now, segregation, but we haven't reconciled. If we had a Department of Reconciliation with a Secretary of Reconciliation, would you work with a Secretary of Reconciliation, your departments, the agencies that you represent? Would you work with such a person to help us reconcile in this country? If so, raise your hand. All right.
Not knowing what that is, I guess,
They
but
both
sure,
would.
if there's a department, then, you know.
Well, I can tell you it would be a department designed to eliminate invidious discrimination and racism. That's what it would be all about at the cabinet level, hopefully. Thank you both. Thank you, Madam Chair. You're back.
Thank you. Mr. Barr, you're recognized for 5 minutes.
Thank you, Madam Chair, and to Secretary Mnuchin and Chairman Powell, I want to thank you all for your very decisive and aggressive actions that you all have taken from the outset of this pandemic. I think both the Fed and Treasury, through the emergency lending and with the tools that we've given you through the Exchange Stabilization Fund, have really made a difference in making a bad situation a lot less bad given the circumstances. So thank you for your actions. And as an example of the agility that you've shown, Secretary, let me thank you in particular for responding favorably to a letter that Representative Hill and I sent to you about streamlining and making less bureaucratic the loan forgiveness application under the PPP program. That was tremendously helpful for both borrowers and lenders, cutting that red tape. The easy form is very welcome, and appreciated the fact that you were responsive to that. Let me ask you a follow-up question about commercial real estate. We've had a couple of questions from Mr. Sherman, Mr. Posey. This is a problem we have not addressed yet. And I'm hearing from many commercial property owners and borrowers in my district across the country, especially hoteliers, where occupancy rates remain very, very low. Shopping center owners, retail clearly has not recovered. Other businesses significantly disrupted by the pandemic. I think we're going to see, without intervention, a wave of foreclosures and defaults. And Secretary, you did identify the problem with the inflexibility of these servicing agreements. But I think you mentioned that we might need additional legislation to allow hoteliers to hire back workers. That's really not the issue. The issue is debt. They can't service their debt because they don't have revenue. They don't have. So my question is, both of you all recently received a letter from me, Congressman Taylor, Congressman Heck, Congressman Lawson, plus over 100 of our colleagues urging the Fed and Treasury to establish a facility to assist commercial real estate borrowers, especially those with CMBS loans. Secretary, you testified that you have $250 billion remaining in the ESF. To both of you, does the Fed currently have the authority to establish such a facility? And do you feel that market conditions in commercial real estate warrant action by the Fed and Treasury?
Well, let me just appreciate and thank you for your letter. This is a large challenge. So we have, working with the Fed, we have not yet figured out a way to set up a facility. So it's not out of a lack of interest or a lack of desire. There are structural problems. And let me just add, in many of these cases, these companies don't need more debt. They need support. So one of the things we will want to look at in the next CARES Act, as I said, is additional support for these hardest hit industries. As the chair has said, there's a difference between lending and spending.
Right. Chairman?
I just would echo, and I've got your letter right here. You know, have been very focused on this, and you said it in your comments, and it's in the letter. You know, more debt may not be the answer here. Debt doesn't solve every problem. You've got people who can't currently service debt. You've got these inflexible arrangements. So there's a serious problem here that needs to get fixed, and we're racking our brains to see how it could be something we could do by lending. But that's really what we can do, is create more debt.
Yeah,
so.
I would encourage you to consider, in some cases, the covenants against additional indebtedness may be too restrictive that these owners could take on additional debt to get them through this period of time. But I look forward to working with you, whatever the answer is. Real quick on Main Street, Chairman Powell, I have heard from a number of lenders and business owners who've indicated that the terms of Main Street may discourage borrowers from applying and lenders from participating. Some lenders have welcomed the changes made recently by the Fed, but many are still far from enthusiastic about participating. What has been the response thus far from the lender community, and how is the Fed going to encourage lender participation given the hesitations?
We've had a lot of interest. We do webinars, we do outreach, and as I mentioned earlier, we've had something like 300, a little more than 300 now, I think, turn up. What the banks tell us is, though, that it's sort of a mixed thing. They're not getting a ton of interest from borrowers. And many of them say that they expect that'll change, over the course of the next few months. They do expect that demand from borrowers will increase. And I'll just echo that we continue to be open to playing with the formula and making adjustments going forward.
Well, my time has expired, but the reason why Main Street doesn't work for commercial real estate is that EBITDA limitation, as you know. But thank you. I yield back.
Thank you very much. And Mr. Powell, the issue of commercials that we've talked about, it's on my radar. We'll continue to talk about this issue and pay attention to what you're saying to us about it. With that, Mr. Cleaver, you're recognized for 5 minutes.
Thank you very much, Madam Chair.
Where is he? Where is that guy?
I'm sorry.
Yes.
Thank you very much, Madam Chair. Secretary Mnuchin, thank you for being here. Chairman Powell, thank you for being here again. I know that you've been asked by a number of members before me about the issue with Black and brown business owners being left out of the pot that we clearly intended to help during these downtimes. And so I'm frustrated, like a lot of people, not only in Congress, but a lot of people around the country. What is your philosophy, Mr. Secretary? Maybe not philosophy, but what do you have to say to a question? Why weren't rural and minority businesses more equally supported in the emergency program? I mean, what do you think happened?
Well, let me just first say we need to all do a better job at making sure that we have sources of funds for those businesses and to support those businesses. In the PPP, we've worked with lots of different people to make sure the CDFIs and the MDIs get there. But across the board, we can always be doing a better job.
And thank you. I guess where I'm now, because I'm here dealing with these minority businesses right now, and if I say we all agree we need to do a better job, do you have any ideas or an idea on specifically what we can do better?
Well, we'd be happy to work with you on that. We've been working with Robert Smith and a bunch of external people to try to figure out how we can use the CDFIs, how we can make sure MDIs have more access to capital. And I think there's a lot of good ideas out there that we need to continue to explore before we have one solution. I think there's multiple solutions.
I'll just add, Mr. Cleaver, I'll just add that we're doing a great deal of outreach with MDIs and CDFIs to get them access to the programs that we're doing, including the PPP. And in fact, we have a meeting with the National Bankers Association tomorrow on July 1st. So we're doing a lot of outreach, and we think it's having an effect.
Thank you. Actually, after you appeared before our committee, I did have about a 35-40 minute meeting with Esther George here in our the Kansas City Fed office, and I said I appreciated her going into detail about issues that we were raising as best as she could. So thank you for doing that. I appreciate that. I just was hoping that the Secretary would understand the pressure that these businesses are under, which means that as representatives of theirs, we are also in tremendous tremendously pressurized situations, and I was, hoping that I could go back and say, this is what we're going to do henceforth. But I appreciate where we are. Many of my colleagues have already raised the issues I was going to raise. I would just say, you mentioned earlier, you can't respond to any classified intelligence, so I won't ask those questions. But I am nevertheless going to send you a letter.
Which caused the human, cultural, business, and political ramifications, and what remedies are currently available or should be created to combat this unfair trade practice. On a bilateral basis, what is clear is the lack of reciprocity from countries like China or Russia and the United States. The Chinese government spends billions of dollars to promote its propaganda overseas, a form of offensive censorship. For years, Russia has broadcast state propaganda in the United States and has justly been designated as a foreign agent. The lack of reciprocity takes advantage of our system of free expression to promote these countries' agenda online, in media, entertainment, as well as our education system. Meanwhile, China and Russia do not grant the United States the same access to its markets or media. Instead, China has been expelling our media, having kicked out 3 Wall Street Journal and other reporters earlier this year over Chinese censorship of COVID-19. For centuries, countries blocked trade through physically restricting access to their ports. Today, the same thing happens, but with firewalls, filters, and outright restrictions to access. In fact, nearly 100% of global internet traffic travels through a crisscrossing network of undersea cables that form the backbone of global digital trade. These cables are another front in the global technology race, with companies like Huawei Marine rapidly moving to control the media by which content and trade is censored. In the era of information where data is the new gold, the blocking or filtering of that traffic by nation states is growing. This censorship is fragmenting our markets, culture, and understanding of one another. The internet itself is becoming less global. Countries like China and Russia are not only building their own infrastructure to cut themselves off from the world, but exporting their authoritarian model to other nation states through efforts such as the Digital Silk Road. It's imperative that Congress support our nation in meeting this challenge, and that's why I'm working together with all of our colleagues in the Senate and in the House to include parts of the CHIPS for America Act in the National Defense Authorization Bill currently on the Senate floor. If we're forced to rely on China to build our networks and our technology, the world we know will be much less freer and open to expression of opinions and do business. This bill will help us create our own domestic production capacity for high-end semiconductors that underpin the technology we use in our daily lives. It will also let the United States remain a global leader in promoting free trade of goods, information, and speech. Finally, I look forward to discussing what remedies are available to address the abuse of censorship as a non-tariff barrier to trade. Last fall, a Chinese-American constituent of mine in Texas reported he was censored here on American soil by the Chinese government. His American WeChat account was shut down for supporting protests in Hong Kong. His response was, quote, "If you have censorship in China, fine. But in this country, I'm a Republican, but I suffer the same as Democrats. We're all censored." I look forward to exploring this topic in the same bipartisan fashion in which we always hope to proceed. It's time for Congress to ask hard questions, and that's why we've called our panel of 4 experts here today to discuss this issue. Let me now recognize Ranking Member Casey.
Mr. Chairman, thanks very much for this hearing, and I want to thank our witnesses for being with us today. This is, as the chairman has noted, the third in a series of hearings held by the subcommittee outlining Chinese government's civil-military agenda and efforts to influence the economic and geopolitical order in a manner that benefits its authoritarian and anti-competitive practices. Just yesterday, the Chinese National People's Congress passed a national security law for Hong Kong that significantly erodes Hong Kong's special status and, based on available reporting, will deny the people of Hong Kong the right to protest, the right to assemble, or the right to criticize their government. The United States Congress has been clear time and again: the citizens of Hong Kong must enjoy certain rights that are distinct from mainland China, and efforts to undermine the status quo is an affront to the people of Hong Kong and decades of international agreement regarding the status of Hong Kong. As I've said before, when it comes to China, we must work with our allies to execute a clear and coordinated strategy. This applies to trade and to the Chinese government's most recent efforts to erode the rights of the people of Hong Kong. Here in the United States at this time, we know that we're in the midst of a public health and jobs crisis. So much suffering all across our country. We've seen the cost of our reliance in the context of this pandemic, this public health crisis, our reliance on a single source supplier, and more to the point, our reliance on production from a non-market economy. Last year, Senator Cornyn and I began this effort by outlining the main issues related to market access in China. We then focused on specific initiatives and actions undertaken by the Chinese government, starting with the Belt and Road Initiative. Today, we turn our attention to censorship. The actions undertaken by the Chinese government include direct barriers, such as blocking movies from entering their market, or restricting content, to blocking internet firms, to dictating content related to China's territorial and economic claims, and to demanding action or inaction by businesses related to Taiwan, Hong Kong, Tibet, and the ongoing human rights abuses in Xinjiang. The Chinese government has become increasingly assertive in its demands within and outside of its borders. Their mandates related to extraterritorial censorship is particularly troubling. The Chinese government's response to a message of solidarity for Hong Kong by the general manager of the Houston Rockets, for one example,